The Minority Market. Episode 54. How to Stay Consistent During Drawdowns. Every serious market participant eventually faces drawdowns. A drawdown is not just a financial event. It is a psychological test. It exposes emotional weakness, discipline gaps, and mindset flaws. Most people do not fail because of strategy. They fail because they cannot stay consistent when results temporarily turn negative. The majority panics during drawdowns. Confidence collapses. Doubt increases. Discipline weakens. They abandon systems, change strategies, and search for shortcuts. This emotional instability causes long-term damage. The minority reacts differently. They accept drawdowns as part of the process. They prepare mentally for these phases before they happen. Because of this preparation, they remain calm when pressure rises. The first step to staying consistent during drawdowns is expectation management. If you expect constant profits, drawdowns will feel like failure. If you expect ups and downs as part of probability-based systems, drawdowns become normal business cycles. Markets move in phases. Winning streaks and losing streaks are natural. The minority understands this rhythm and avoids emotional overreaction. Another important concept is separating identity from performance. Many people attach their self-worth to profits. When losses appear, confidence collapses. The minority separates personal value from portfolio performance. They treat trading and investing as professional processes, not emotional validation. Let us talk about risk control during drawdowns. When losses accumulate, emotional pressure increases. The minority responds by reducing risk, not increasing it. They protect capital and emotional stability by adjusting position size. Trying to recover losses quickly is dangerous. It leads to revenge trading and impulsive decisions. The minority slows down during drawdowns instead of speeding up. Another critical habit is sticking to process. During difficult periods, discipline matters more than ever. Following rules consistently prevents emotional mistakes. The minority focuses on execution quality instead of outcome obsession. Process thinking builds emotional stability. Outcome obsession creates stress. Let us discuss self-review. Drawdowns offer valuable feedback. They reveal weaknesses in strategy, execution, and emotional control. The minority reviews mistakes calmly. They analyze data. They adjust rules if needed. They improve systems instead of blaming the market. But they avoid emotional over-optimization. Changing systems too frequently during drawdowns often creates confusion. The minority makes careful, data-based adjustments. Another powerful tool is routine stability. Maintaining daily routines creates psychological stability. Sleep schedules, exercise habits, journaling, and market preparation rituals keep the mind grounded during stressful periods. Routine reduces emotional chaos. Let's talk about patience again. Drawdowns require patience. Recovery takes time. Forcing recovery creates deeper losses. The minority allows performance cycles to normalize naturally. Another important concept is long-term perspective. When you zoom out mentally, short-term drawdowns lose emotional power. A temporary decline becomes small compared to multi-year growth. The minority constantly reminds themselves of the bigger picture. Let us address social pressure. During drawdowns, social comparison becomes dangerous. Seeing others post profits creates emotional pressure. The minority avoids comparison during difficult periods. They focus inward instead of outward. Another emotional challenge is boredom combined with losses. When markets are slow and performance is negative, frustration increases. This often leads to forced trades. The minority accepts slow phases and avoids emotional activity. There is also emotional fatigue. Repeated losses drain mental energy. The minority protects emotional capital by taking breaks when needed. Rest is not weakness. It is recovery. Professional athletes rest between competitions. Professional market participants also require mental recovery. Another important habit is positive reinforcement. Celebrating discipline, not profits. If you followed your rules during a losing trade, that is success. This mindset builds confidence even during drawdowns. Confidence built on discipline lasts longer than confidence built on profits. Let us talk about emotional neutrality. During drawdowns, extreme optimism and extreme pessimism are both dangerous. The minority stays neutral. They avoid emotional extremes. They remain objective. Neutral thinking protects clarity. Another key is emotional acceptance. Fighting drawdowns emotionally creates stress. Accepting temporary underperformance reduces mental resistance. This acceptance creates calm decision-making. Over time, repeated drawdown experiences strengthen emotional resilience. What once felt painful becomes manageable. Emotional tolerance grows with exposure. This is how emotional maturity is built. The majority collapses under pressure. The minority adapts. They remain patient. They remain disciplined. They remain consistent. And this consistency is what allows them to survive long enough to benefit from long-term compounding. Because markets do not reward perfection. They reward endurance. They reward discipline. They reward those who can stay calm when others panic. And those who master drawdowns master the most difficult phase of the market journey.